All right, let's go ahead and continue on. So here we are. So the next thing I want to do is, we're using estimates to come up with this predetermined overhead rate because we're doing estimated overhead and estimated driver. Sometimes, well, always, it's not going to come out perfect because we don't know exactly what the overhead is going to be and the exact number of hours that we work. So if we're using direct labor hours, the only way we're going to come out perfect here is if we estimate all of our costs perfectly. So we know exactly what our utility bill is going to be to the dollar, and our supervisor salaries and our depreciation and all of our costs perfectly, which doesn't happen. You can't estimate perfectly on that. And so what's going to happen is we're going to have some extra. We're going to have a little bit of an offage, and we have to decide what we're going to do with that. So it says calculate the amount of overhead allocated to products that has a predetermined overhead rate of 10 per machine hour. So this is the rate that we're given, $10 a machine hour, if machines are used for 10,000 hours. So our machines run 10,000 hours at $10 an hour. So 10 per machine hour times 10,000 equals 100,000. So what if the company actually spends 95? So we thought that our rate was $10 an hour based on our estimates. And then we went ahead and we worked 10,000 hours. But when the bills came in, we actually only spent 95. So it looks like we applied too much. We applied too much. So the company has over applied overhead. We applied too much. And I'm going to walk you through several examples of this, and so it'll make more sense as we go through. And so what's going to happen is we're going to keep track of this cost in a T account. So we've got our T accounts that we've used over and over again. And so our overhead account is going to be a new T. So you have your raw material WIP, finished goods, cost of goods sold. And so you guys have those 4 that we learned in chapter 2. Now we're going to add an extra one. And so this is going to be our overhead account. And it's going to be a temporary account. Temporary means permanent versus temporary. Temporary are red ones that are closed. So this is chapter 4 of financial accounting. So temporary accounts are accounts that have to have a 0 balance at the end of the year. So a temporary inventory account that must have a 0 balance at the end of the year. So at the end of the accounting period, we have to zero this account out. We cannot have a balance in it. It cannot be positive. It cannot be negative. It does not have a normal balance because the balance can be on either side. And so we're going to keep track of our overhead and we're going to zero it out at the end of the year. So all of our overhead costs are going to be included. On the debit side, we're going to have actual overhead. And on the credit side, we're going to have our applied overhead. Okay, so credit side is applied, debit side is actual. Okay, so if the actual side has all of these costs, and let's say it equals 364, and then our applied side has 360. So what I would do now is and I can't do it on this because I can't, I guess I can. I'm going to write right here. So this is the actual side, and this side is called the applied side. So what I want you to notice is when we're looking at actual and applied, it goes in alphabetical order. So you read from left to right, actual, applied. So this side is going to have all of your actual costs on it. And then every time we apply overhead, we're going to put it over on the credit side. And so let's check and see what the balance of this account is. So I would get out my calculator and I would notice on the debit side, I have 105, 190, 24, 40, and 5. So I have 364. So I might write that down over here in the margins. So this side is 364. Over here on the credit side, I have 162, 54, 72, and 72. So I have 360. So if this side is 364, then this is the bigger side. So the balance in this account is 4,000. And it's a debit because my actual side, my debit side, is bigger. So what happened here is we only applied 360, but our actual is 364. Now, students often ask, is that good? Is that bad? And what we're going to do is we're going to close it. I don't want you to worry about if it's good or bad. In this situation, it's actually bad for us because when we assigned cost to jobs, we only assigned 360, but our actual came in at 364. So we have 4,000 that we did not assign to jobs. So this isn't good for us, okay? So, but in general, it doesn't really matter because what we're going to do is we're going to close this out because overhead is a temporary account and it has to have a zero balance at year end. So this $4,000 balance is, let's see, we did not apply enough. And so we are under applied. Okay, we are under applied. If you apply too much, then the balance will be over here on the right side if you're over applied. So in this situation, what we need to do is we need to zero out that balance. So we got to get it to zero. So to get it to zero, you need to credit overhead to make the balance zero. If you debit overhead in the closing process, if you debit overhead by 4, then your balance is going to be 8 as a debit. We want the balance to be 0. So to get it to 0, you need to credit overhead to get rid of the balance that's there. So there's actually 2 options on how to close it. You can just send it all to COGS. You can send it all to COGS to close it out, or you can allocate it. So I want to show you guys something. Let me go here. I'm building the spring schedule, so that's what that is. But let me go ahead and pull up the inventory flow worksheet. Okay, so look in here, inventory flow. Okay, so what I want to look at is, this is what we learned in chapter 2. So you guys, this is familiar to you because in chapter 2, we started this idea of our 3 inventory accounts: raw material, WIP, and finished goods. The little asterisk, I always have that in there because I copy and paste this a lot. And that just means that these are all asset accounts. And then COGS is an expense. Expenses go on the income statement. So COGS is going to go down here onto the income statement along with your selling and admin expenses to get you your net income. And so as we start this chapter at 3, what we're looking at is we have a new T account and its name is overhead. So I would come down here and I would build an overhead T account. And so I'm going to get rid of that green color. And so this is MOH. And over on the debit side, we'll put actual, and on the credit side, we'll put applied. And so as we're looking at this, what happens is this overhead right here is applied overhead. So every time we have a job, we're going to do direct material, direct labor, and overhead applied. And then as we finish the job, we're going to take it out of WIP and send it to finished goods when we sell it out of finished goods into COGS. So this number, this green number, is COGM. And then this is COGS. And so what will happen, and in this situation, what I'm looking at was I had 364 over here, and I had 360 over here. So the balance in this account is 4 as a debit. And so to close it, I need to credit because that will bring it to 0. So I'm going to put a number over on the credit side, and that will get rid of the balance. And then my balance will be 0 because I want my balance to be gone. If I debit it, then my balance would be 8. That is not what I want. I want to make the balance go away. So if I credit here, for every credit, there must be a debit. Okay. So if I credit here, then I will debit here, which will throw that $4,000 into the COGS account. So the reason why we can do it like this is the number that was wrong. If I had good information, then instead of 360, I would have used 364 for applied. Because if I used 364, then I would have had 0 for my over under. And if I'd used 364, then this number would have been 364. In this case, it was 360. So 360 went in here and then completed, and then it's sold, and then eventually it lands in COGS. So this number was off by 4. So then this number was off by 4, off by 4, off by 4, off by 4. And so putting the 4 here fixes the number. So the other way we do it is to allocate proportionately between WIP, finished goods, and COGS in proportion to overhead applied during the current period. So what we do is we actually look at the jobs that we started this year and figure out, like, some of them are still sitting in WIP and some of them are completed but not sold, and then some of them are sold. So instead of just debiting COGS for the whole thing, we put maybe 1 here, 1 here, and 2 here. And so we allocate. I'm not going to make you guys do that in this class. We save that for cost accounting. So for my accounting majors, you do get to do that, but we won't do it until cost accounting. So, because that's more of an advanced topic. So in here, we're always just going to send it to COGS. So again, if you're crediting here to get rid of the balance and overhead, remember the goal is to zero it out. So if you credit here, then you debit here. Okay. So back over here. So we are going to use this method. This is the method that we're going to use. And so what we'll do, and by the way, the way you decide what method to use is it depends on how much you're off by. In this case, we were only off by 4,000 on 360, which is not that much. But if we were off by 100,000 on 360, then we were really messed up. Our estimates were really bad. And in that situation, we would need to allocate between WIP, finished goods, and cost of goods sold instead of changing COGS by 100,000. If some of the goods are still sitting in WIP and some of the goods are still sitting in finished goods, we would need an allocation. So in this situation, because the balance is over here, then I need to credit overhead. So, hear me, indent? All right. So I'm going to debit MOH, and then I always close it to COGS. So the other side of this entry will always be COGS. And so we're going to do journal entry for 4, and that will get rid of this balance. So then that balance goes away. So now what I want to look at is what if I had this situation? So I had actual of 357 and applied of 360. So in this case, I applied too much. I applied too much. So I have 3,000 over applied. So we applied too much in this situation. So to get rid of it, I need to debit MOH. So I will debit MOH and credit COGS for 3,000 to get rid of the balance. Okay. So now we can do another example of this before we move on to doing all of the entries. Okay. So as we look at this one, it says draw a picture of the MOH account below and show where actual and applied is. So I went ahead and drew the T account for you. That's because me drawing a T account using Word is kind of a pain. So I went ahead and drew the T account for you. Show where actual and applied is. So this is actual and this is applied. Swanson Manufacturing has just prepared their budget for 2024. They expect that their total overhead cost will be 500,000. So that means it's an estimate because it says will be. We're estimating. We expect that our total overhead cost will be 500,000, and our primary cost driver is going to be machine hours, and we estimate that we're going to work 100,000 machine hours. So what is the predetermined overhead rate? So our predetermined overhead rate is estimated overhead divided by estimated driver. So we would take 500,000 divided by 100,000, and we get 5 per machine hour. Okay, so 5 per machine hour is our predetermined overhead rate. And I always do this per, because later on, when you have a whole lot of different numbers going on, you need to see what that predetermined overhead rate is. So one job that we completed during the year involved 1,000 machine hours. So what's the overhead applied to that job? So that one job, had 1,000 hours. And so 1,000 times 5 per machine hour would be $5,000 of overhead. At the end of the year, we discovered that we incurred 490,000 in overhead, and we worked a total of 101,000 hours. What is the amount of over under? So then it says show the T account demonstrating the over under, and then we're going to close it out to COGS. So it says that we incurred 490. Incurred means it actually happened. So the word incurred freaks out accounting students. They're like, what is incurred? Does that mean actual? Does that mean applied? Incurred means it happened, that we actually incurred 490. So the actual is 490. And then we worked a total of 100,000 hours. So that's how many hours we worked. And so for every hour we work, our rate is $5. So we apply overhead at 5 times 101. So that would be 505. And so you can draw an arrow to that. I don't know that I can. I can't. But draw an arrow to that and say 101,000 times 5. So it looks like we applied too much by 15,000. So we are over applied, right? So to close that, we need to debit overhead because I need overhead to go away. again, if I credit overhead by 15, then the balance is 30. I want the balance to be 0. So to zero it out, I need to debit overhead. So I'm going to debit MOH. And the other side, when you close overhead, is COGS. So 15,000. All right. So this is another good place to stop, and then we will finish out our notes.